Picture this. You've been saving for 3 years, watching every dollar, skipping the coffees, maybe even skipping a few holidays, and then you open the news and see Australian house prices are falling. Your first thought is probably, finally, maybe this is my chance. But then you scroll down and see the RBA has kept rates at 4.35%. Inflation is still above target, and nobody really knows where things are heading next. So you're left thinking, mate, what's actually going on here? Is 2026 finally becoming a better time to buy, or is there something underneath these falling prices that we need to look at? So let's break it down, run through some real numbers, and see whether buying right now actually makes sense. So first, what's happening with house prices? Cotality's July 2026 data shows the downturn has spread further, with combined capital city values falling 0.9% over the month, which is the biggest monthly drop since December 2022. Sydney and Melbourne are leading the falls, but it's not just those two. Brisbane, which has been one of the strongest markets over the last 5 years, has now turned negative as well, falling 0.6% in July and sitting just below its May peak. And even after that fall, Brisbane is still up close to 15% over the past year. The median dwelling value is around $1.1 million, so this is the important bit. Prices might be falling, but they're falling from a seriously high base. So why are prices actually coming down? There are basically three things happening at the same time. First, affordability has become a massive problem. Property prices have gone up much faster than what a lot of households can comfortably borrow. Then you've got the bank's serviceability test. Basically, when you apply for a mortgage, the bank checks whether you could still afford the repayments if your interest rate was another 3 percentage points higher than the rate you're being offered. It doesn't mean everyone automatically loses a certain amount of borrowing power, but if you're already borrowing near your limit, that stress test can seriously restrict how much the bank is willing to lend you. And then there's demand. Buyers have started pulling back, while more properties are coming onto the market. Brisbane listings, for example, are up 23.2% compared with a year ago, and auction clearance rates across the combined capitals have stayed below 50% for 6 straight weeks. And when there are more sellers and fewer buyers fighting over the same properties, guess who gets a bit more negotiating power? Yep, the buyer. Now, if you're a first-home buyer, this is where things get interesting. Falling prices sound like great news, and honestly they can be, but there's a trap here. A cheaper house doesn't automatically mean buying becomes easy. Your deposit and borrowing hurdles don't necessarily fall as quickly as the property price. Say a home drops from $800,000 to $760,000. That sounds pretty good, right? You've saved $40,000 on the price. But if you're aiming for a 20% deposit, your target only falls from $160,000 to $152,000. So you've saved $8,000 on the deposit requirement, while you're still looking at a loan of more than $500,000. So yeah, falling prices help, but they're definitely not some magic button that suddenly makes property affordable. Let's make this a bit more real and run through an example. Say you find a $750,000 property. That's actually below Brisbane's current median, but it gives us a nice round number to work with. If you put down a 20% deposit, that's $150,000, leaving you with a $600,000 mortgage. Now, just for the maths, let's say you get a variable rate of 6.3% over 30 years. Your mortgage repayment would be roughly $3,714 a month, or about $857 a week. And remember, that's just the mortgage. You've still got council rates, insurance, maintenance, and all the other costs that come with owning a place, so think of that $857 as the floor, not the complete cost of owning the property. Now compare that with Brisbane house rents, which are averaging around $670 a week in 2026. So right now, renting can be meaningfully cheaper week to week than owning, even though property prices have started falling. But let's not just guess whether buying or waiting is better. Let's actually run a little experiment. Imagine two Australians, both starting today with $150,000 saved. Person A decides to buy the $750,000 property. They put down their $150,000 deposit and borrow $600,000 at 6.3%. Over the next year, they'll make roughly $44,568 in mortgage repayments. But here's something people sometimes miss when they look at that number. Most of those early repayments are interest. Roughly $37,800 would go towards interest, while only around $6,700 actually reduces the loan balance. That's just how a normal amortizing mortgage works. Then you've got stamp duty and the other purchase costs, which in Queensland could easily add another $20,000 to $30,000 depending on your situation and any concessions you qualify for. Now imagine property prices fall another 5% over that year. That $750,000 property is suddenly worth around $712,500, which means person A is looking at a $37,500 paper loss. Person B takes the other approach and keeps renting. They rent an equivalent property for $670 a week, which works out to about $34,840 over the year. They don't build property equity, obviously, but their original $150,000 deposit is still sitting there, liquid and available. Now, just as an illustration, say they invested that money and got a 7% return over the year. That would be roughly $10,500 in growth. But I want to be really clear here, 7% isn't guaranteed. The investment could return more or less, or even lose money over a particular year. So when you line these two people up after just 12 months, it's actually pretty hard to say one clearly one. Person A has built some equity by paying down the mortgage, but they've also paid the upfront buying costs and could be sitting on a paper loss if prices continue falling. Person B has spent money on rent and hasn't built property equity, but their $150,000 is still liquid and potentially earning a return. And that's exactly why the whole "should I buy or wait" question is so difficult. Over 1 year, there isn't always an obvious winner. It depends on what happens to property prices, rents, interest rates, and investment returns. And honestly, the biggest thing here is time. Buying property is usually a long-term decision, so trying to judge a 20 or 30-year decision based on what happens in 1 year can be pretty misleading. Now, there's another mistake I reckon buyers really need to watch out for in 2026. And it's not necessarily buying at the wrong price. It's borrowing too much. If borrowing capacity starts improving, it can be really tempting to say, well, the bank will lend me $900,000, so maybe I should spend $900,000. But just because a bank is willing to lend you a certain amount doesn't mean you should borrow the maximum. The RBA has kept the cash rate at 4.35%, inflation is still above target, and the outlook is uncertain. If you borrow right up to your limit and rates move against you, even a relatively small increase can put serious pressure on your household budget. So in a market like this, I'd be much more interested in whether you can comfortably afford the mortgage than whether you can technically get approved for it. There's a massive difference between those two things. And there's another thing first-home buyers should know about because it can completely change the deposit calculation. The Australian government's 5% deposit scheme, which is the rebranded and expanded First Home Guarantee, has changed the equation for eligible buyers. Since October 2025, there are no income caps and no annual limit on the number of places. Eligible first-home buyers can potentially buy with as little as a 5% deposit and avoid lenders' mortgage insurance, with the government guaranteeing the gap. So on our $750,000 example, instead of needing a $150,000 deposit, you could potentially be looking at $37,500. That's a massive difference in the amount of cash you need upfront. But obviously there's a catch. You still need to qualify with the lender, you still need money for the other costs of buying, and property price caps apply depending on where you're buying. So don't just assume you qualify, check the actual rules for your situation. So when does buying actually make sense? Well, if you're planning to stay in the property for at least 5 to 7 years, you've got a stable income, and you can comfortably handle the repayments even if rates move higher again, then buying can make a lot of sense. Over time, part of every mortgage repayment goes towards reducing the loan, which gradually builds your equity. Renting doesn't work that way. But that doesn't mean buying automatically beats renting financially. If your income is unstable, you might need to move for work, or buying would leave you living right on the edge of your budget, then renting could genuinely be the smarter move. And if you actually invest the money you would have put into a deposit, and the difference between your rent and ownership costs, that can potentially work out very differently depending on what happens with markets over time. So here's the big takeaway, mate. Falling house prices by themselves are neither a green light nor a red flag. They're just one part of a much bigger calculation. You've got to look at your deposit, your borrowing capacity, your income, your other expenses, the interest rate you can actually get, and probably most importantly, how long you're planning to stay. I wouldn't be trying to perfectly call the bottom of the Australian property market, because honestly nobody knows exactly where that bottom is. The better approach is to work out what you can comfortably afford, understand the risks, and then decide whether buying or waiting makes sense for your situation. Because the people who do well over the long run probably won't be the ones who perfectly timed the cheapest week to buy a house. They'll be the ones who made a decision they could actually live with financially and then gave it enough time to work. If this helped make the whole thing a bit clearer, hit subscribe and turn on notifications so you don't miss the next one. Thanks for watching, mate, and I'll see you in the next one.